Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar or website of promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment security or transaction. Trading options involves risk. Visit the OCC website, www.optionscreen.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options. We are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harms from any losses you may incur as a result of the information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. All right, and now that we've started the webinar, the Dow is up 220 points, which I think is the most for the day. No, maybe not. Maybe it was up higher before. That's weird. Oh, no, what's weird is CNBC says 220, but it's not actually 220. Why would that be? NASDAQ plus 90, that's correct. Dow 223, it says. Oh, because of the futures. Okay, yeah. All right, so the Dow futures aren't keeping pace with Dow so far. It's going up so fast. We will see what happens, though. So the futures did spike all the way up to 26.4 this morning. That was a bit higher earlier. I didn't see the Dow actually hit that high. So we're kind of having a little bit of weirdness, but what can you do? And we'll see what happens with the trade. And Powell already spoke, actually. I'm sorry, we should have checked on that. Let's take a quick look at what he said today. Twitter is the best place to figure that out, usually. Powell. Powell. And he wouldn't have said anything different. He said every other day this week. They're going to increase their balance sheets, which is kind of like QE, but they're trying to say it's not. This is not QE. That's funny. This is not QE. This is in no sense QE. Oh, yes, it is. That's pretty funny. All right. Well, as you can see, so nonsense from the Fed continues. Charles Powell's a lot of Powells. Okay, there's too many Powells on the web. Powell, Fed. Maybe that'll cut it down. Nothing new from Powell. The Fed meeting minutes are on the deck in a little less than an hour. Powell said it was a bit of a puzzle why wage growth has not yet taken off. 3 new books on. How does everything turn into an advertisement? Powell to Fed, oh, that's another language that makes it confusing. Why do I follow this person? Why do I follow a person from Brazil? No, I don't. Oh, I'm looking it up, that's why. Haha, I see I wouldn't come up in my Twitter feed if I wouldn't follow somebody who doesn't speak English. Not that there's anything wrong with not speaking English, just that I don't speak other languages. All right, so I speak French very badly. Powell said if he didn't repeat no QE several times, the Fed staff would not let him back in the building. I'm sure the Fed staff would. All right. This is just all so silly. Powell says planned bond buying isn't emergency stimulus. Oh, that's pretty funny. That's like the hospital putting 2 quarts of blood in you and saying it wasn't an emergency. We just felt it was a good time to put some blood in you. Oh my God. Well, it isn't an emergency. I mean, that's a funny thing. I guess you can pick apart his phrase because it's not an emergency. The market's at an all-time high. The economy's really pretty good. Unemployment is at all-time lows. These are not emergencies. We're doing this only to make President Trump happy and keep the market up and make it look good. You know, it's not healthy for the market to never go down. There's no price discovery. That's why things are just getting more and more and more expensive. And it's annoying for us because we cashed out, but what can you do? See, like this one says, El Presidente de la Reserva Federal, Jerome Powell, abre la puerta, and engordar el balance Fed. In other words, what the hell is this man doing? Yeah, okay. Well, that seems to be the gist of it. He's basically trying to say his bond buying isn't an emergency stimulus. All right. Well, so meanwhile, that's good, and everybody's happy, and the market's up because the Fed. I guess the subtext on that is the Fed saying, "Hey, this is an emergency stimulus. Wait till you see what we'll do when we have an emergency." So I don't think this is ever going to normalize at this point. This is crazy. Oil came off its highs and it's actually fading now because let's take a look at that. We can take a look at the EIA report, which should be there. And let's see if this can't be the recent one. September 20th, that's way off. Let's refresh. October 4th, that makes sense. Okay. Crude oil imports, refineries. Where's the part where it says how much distillates? U.S. oil, motor gasoline. Where does it say what oil did? How weird. U.S. commercial oil inventories accepting increased by 2.9 million barrels. Okay, so they went up 2.9 million barrels. The motor gasoline decreased 2 points. So the drawing gasoline, a build-in oil, and then distillates are the tiebreaker. Now this is interesting though, because it says 3.9 million barrels. And that is not the number we got earlier. Oh no, maybe it was. I'm sorry, that was the API number I'm thinking. That's why I couldn't figure out where the numbers were. I'm thinking the API number was much bigger. All right, so anyway, so nothing too exciting there. Refinery activity, any significant slowdown? The crude oil input was about the same. The capacity was a bit, the capacity dropped a bit. Gasoline production is down a bit, and now so you notice it's not a nothing thing. I mean, gasoline production is down 700,000 barrels. So when they tell you the gasoline decreased 1.2 million barrels, 700,000 of that is because they produced less gasoline this week. Of course it went down to produce less gasoline. Same thing goes with distillates. They produced another 700,000 less of distillates. So 1.4 million of the net draw of oil is because they just produce less stuff. The oil input was the same, so they didn't put more oil in and produce less, or put less oil in and produce less. They put the same amount of oil in, but they produce less stuff. That means that it's backed up somewhere in the refinery, and eventually it'll pop out. That's why you get these big variances sometimes, because it just depends on where it is in the cycle. Now, this is very interesting though. See, from 927, we had 1941. So we had a very big draw of all other oils. That's very interesting, because usually it never works out that way. But in this case, we had a very big draw of all other oils from 512 to 507. So all other oils are specialty oils and chemicals and things like that. Also jet fuel. So it's interesting that suddenly went like that. Don't know why, but that's bullish, actually, more bullish than the report indicates. Our imports of oil were down 200,000 barrels a day. So there's 1.4 million barrels less imported than we usually have. Petroleum products exported were the same 3 million barrels a day. 21 million barrels a week, more than we consume in a day, is being shipped out of the country. How crazy is that? An entire 1 day supply per week is being shipped out, and that's getting worse, right? You know, as well, you know, from 10.5 to now, this is where our oil is going. It's going out of the country. We're shipping out another couple of 100,000 barrels than we did a few weeks ago. We just keep shipping more and more and more oil out of the country. You know, and the prices are pretty crazy. I mean, they're better than last year. Last year it was $74 for oil. Now it's 52. It was $2.90 for gas, and now it's $2.60. Now, interestingly, oil is down $22 out of 74. I can't do that. It's a fasting day for me, so I can't do math. It's 22 divided by 74. So that's 30% down. And gasoline is down not even 30 cents, 26 cents. Well, we know that's 10%. 26 cents divided by 290 is 9%. So gasoline is down 9%, oil is down 30% from last year. How's that for a ripoff? So we're getting really screwed at the pump on gasoline. Now that does mean though, if oil keeps going down, we can get a pretty big correction on gasoline, but what it also means that is Valero must be making a ton of money, because Valero is a big refiner and they obviously make money on the spread between oil and gasoline. So then that becomes an interesting thing to kind of look up and figure out what's going on. I was going to look it up there, but it's here. VLO. And they are generally the best refiner. They're the cream of the crop of the refiners. So look at the jump in revenue from last year. So 94 million last year, 117 million this year. But why are they making less money? That's interesting. They're making less money now than they did last year. That's messed up. So, I haven't been following for years, but I mean, it just seems that's pretty odd. Their market cap at $85 is 34 billion against a 2 billion plus. See here, for a long-term investment, they're nice, right? Because if they're going to trough out at 2 billion this year, sorry, if they're going to trough out at 2 billion, and I don't know why they'd be having a bad year though. That's what I don't understand. Why would they be having a bad year if gasoline is holding up so well compared to oil? Oh, well, I guess the actual, no, still doesn't make sense. The price of gasoline is less, yes, obviously. It's only 10% less, so it's not that much less. That would explain why we went from 117 to 104. But the main cost of the gasoline is the oil, and oil's down 30%. So they shouldn't be, you know, I mean, I guess maybe over the course of the year it hasn't been as favorable, but it's kind of weird that they shouldn't be making more money. Oh, I like that. I didn't know I did that. Look how cool that is. The little graph comes up when I do this. Wait, oh yeah. Net profit, very cool. I don't think it used to do that. I love it. Wow. How much fun is that? Kudos to Stockopedia, very nice. Get a little graph every time I want to look at something. What I'd like to see is what quarterlies are. And this is because, you know, Valero, to me, it seems like it's probably priced too low. There's too much fear in the price of Valero, and I think it's probably going to make a good value pick for next year. It's certainly a good hedge on inflation. It's a good hedge on oil prices, trouble in the Middle East, anything like that. You know, it's got a lot of ways it can win. So quarterly, income, look at this. The gross profit is huge, $2 billion, very nice. Then what happens? Oh, their operating expenses really pounded. Look at how they jumped up 5 billion extra operating expenses. What did they do? They must have done something. It really ran that up. It might have been just fluctuations in oil prices, but it's hard to say. Very strange. Anyway, I'd like to look into them more before calling them an actual pick, but I do like Valero down here. And if we take a look, I bet we can probably construct some good, well, there's a big chart on that. I don't want to break that. Open that in a new tab. Gallery view, VLO. So they're about 35 billion where they are now. They're not, see, the thing is, they're not low in the channel. It would be nice to pick them up if they come back down to 70, but they're at a range that I feel pretty comfortable with for the long term. So, you know, if we take a look at what we could do with Valero, might be interesting actually. All right, so Valero, we'll start out with the easy thing. We would definitely buy them for $75. So if we sell the 75 puts for 11, whatever, nearly 12 bucks for the 75 puts, that means you're going to get any kind of, look at the spreads. I mean, you can get any kind of spread you want. So let's say we sold 5 of these things for 75 for 12 bucks, it's $6,000. And let's say at 85, let's just play them to go up a little bit to 90. So we would, these are 11 and these are, let's call that 21. So we can buy the 70, 90 full call spread for $10 and sell. So we can buy 10 of those for $10. That's a $20,000 spread. The Valero C, you buy the $70 calls for 21. You sell the $90 calls for 11. That's a $10 spread, and that would be $10,000. Then you sell 5 of the $75 calls for $12. That's $6,000. Now it's $4,000. So you're spending $4,000 on a $20,000 spread. You have $16,000, 400% potential upside on that. And all Valero has to do, it's 85 now, is get to 90 in 2022. So I definitely like that trade a lot. That's like top trade quality because it's, you know, it's a pretty consistent thing. We're not getting, we're not, gasoline cars aren't going away in 2 years or even 5 years. They're not going to be, there won't be huge inroads. And they're going to make money either way. Even if the price of gas goes down, they still make money. Doesn't change it for them. It just depends on the spread between the price of oil and the price of gas. So that's pretty interesting. So the next step I would go to as far as putting them on the watch list and calling it an official thing is to say, what can blow up for Valero? So then I have to like really start getting deeper into analysis and say, what could really go wrong that if the market tumbles, we don't even want them anymore if they drop 20 or 30% on us. And that's where it gets a little bit trickier. Do we have a Yahoo chart? Yeah, so we do VLO. Wow, so I gotta reboot this computer. I assume that's what it is. So that's 5 years. You know, you're not really. I mean, well, it had a crisis. It had already a big drop. So that's been the crisis from last year. Wow. Seriously? Yeah, those long-term charts is still broken. It's very upsetting. I don't even take this seriously at all. I mean, the numbers are clearly wrong. Let's see. Do we see the indication of this thing? Yeah, that's still there. No, this is 97, 98, 2000. Wait a minute. Oh. It's just coming out in the wrong place. It's still there. It just is weird. That's pretty odd. Okay, anyway. So as you can see, in the last financial crisis, yeah, the low collapsed from 75 to 25, and currently it's fell from 125 to 75, so nowhere near the kind of fall down here. This is 2/3 down, and 2/3 down from here would be like 45 or 40. So that's your worst case scenario. And if we're going to come in at net 75 and own 500 shares, are we going to be happy at 45 to add 500 more and average 60? I think so, given the price of those options and given the price that we can sell calls and puts for, I think it's still going to be a good buy. So, you know, we're probably going to want to take it easy, but we'll see. But again, I'm saying if you have an incredibly bad case scenario, but I don't see that really happening again. Don't forget this was a don't forget this was really a panic. It wasn't justified. The earnings were still there. This was just the greatest time in the world to buy stocks. I mean, you buy anything for ridiculously low prices. The reality is the 50 should be pretty solid floor for these guys. So, you know, it's not a bulletproof position, but it certainly has a lot of potential, I think. Bill, can you do a control plus so we can see the numbers? I'll try it, I guess, on that thing. I'll try to do that next time. Really, they're all right. I guess the other ones are smaller, right, on the other page. And please talk about gas futures, NGJ20. Wow, I talk about specifically natural gas NGJ20. That's interesting. How is this different from another one? Forex futures. Oh no, that's the one I want. Wait. Charts, flexible grid. Okay, so that's into April next year. And this chart doesn't go very far. It's only a 10-minute chart. So let's make that a 180-day chart. All right. Actually, you know what? I'd like to see an even longer one. Let's go by a year. All right. So April, last April was actually when natural gas topped out last year, but it was never this low. It was only down here. It was only 250 last year, and it only went up to 265. So really, last year gas was 255 in October, and we were actually in this part of October. So gas was 250 in October, 255. It went as low as 240, and only went up to 265. So it dropped 15 cents and then ended up 10 cents higher in April. So your range was a 10-cent range from the consolidation. So now we look back here a bit and we say, well, your consolidation is really about 230. So you'll be lucky to get to 240, and you could easily get down to 220 and possibly even 215. So I'm not sure what you want to say about that. There's no catalyst for natural gas until it gets colder. I mean, this is the worst time of year for natural gas because people shut off their swimming pools, and it's before and especially the weather we've been having lately in the States, it generally isn't that cold, and people aren't using a lot of natural gas in the winter like they usually do. So, you know, if you, as a futures contract, I certainly don't see any particular advantage to it. Excuse me. It's kind of reasonably priced, I'll say that for it. I mean, because you have until April, and the regular NG contracts, which are probably X's at 223. NGN20 is what, July, I think, right? So that's 250. See, the buys are cheaper. You might want to consider that. The Julys are cheaper, and that's because nobody thinks it's going to be expensive in July. Well, and look at that. October is cheaper next year. So that now becomes my answer on NG whatever the heck it was, J20. Why would you have it? Why would you have the most expensive contract in the strip? That doesn't make any sense, because if there's going to be a bottom, the bottom is more likely to stick on a contract that's closer to it. So I especially because I really have more time. NGZ20, that's back to 250. So it seems like the sweet spot's like V, and that's next year in October, I think. Yeah, October. So I would rather have the NGV20 than the J20, because you have, instead of March, you have October up. Oh, 226. I'm sorry. What was I thinking? 226 as opposed to NG now is 223. I don't know what I was thinking. Okay, sorry. So 223, I think my original thing was I was saying it was reasonable. 220, 226, 224, 226. So that's a reasonable price for March. And V20 is 235, so it's 10 cents more. But I still would rather have the contract for 10 cents more. That's a lot longer out of time, give me 6 more months to hopefully catch a break, because they're all going to go up. They're very, very similar. So if it goes up 10 cents in the front month, maybe it'll only go up 8 cents in a longer month or something like that, but I'd rather have the time and hopefully get it right. But that depends too, because if you're playing a natural gas contract and you've got a stop out, like you have a limit that you can take if it goes down, the problem is it doesn't matter what your time frame is, that it's just as likely, you always have to imagine it's just as likely to go down as it is to go up. And therefore, if you set a stop at a down point, you are just as likely to hit that stop as you are to hit the top. But the problem is that when you stop out and it bottoms, you're done. You don't get a chance to see the top. Now, we haven't played much natural gas lately because it's been on an erratic downtrend. Hopefully it's going to stabilize down here and we can start playing it again more often. Last year we played it constantly and had the best time. Well, even earlier this year. Last year we were playing it up and down on the 250 line all the time. It's great. This year it's been looking a little shaky, so we got to worry about what's happening with it. But anyway, so the bottom line is there's no catalyst in April for natural gas. I mean, you're coming through the winter, but you have the same catalyst if you hold the October contract, which at least takes you through the hurricane season. But like I said, if you have a place you're going to stop out along the way on a bad trend, then it doesn't matter what month you take, right? You're still going to stop out and not have it to continue. My thing is I don't really stop out. Like if something goes against me, natural gas, I'll sit on it. You guys have seen me do that. I will sit on the thing with a $10,000, $15,000 loss on a contract because I'm like, well, it doesn't last. What doesn't last could mean months and months and months. You know, if you have the margin in your account to deal with that, then it doesn't matter that you have a short no loss. Obviously, it doesn't matter if it ever comes back. If it never comes back, then you're wrong and you're screwed. But that's, you know, well. I mean, I almost feel like it's never the case, but you know, it's that Keynes quote where he says the market can remain irrational longer than you can remain solvent. It can go so much against you that you just really want to move on and not take it anymore because it's just like sucking up your portfolio. We had that with something. I forgot what it was we took a loss on, but it was one of these commodities we ended up taking a loss on. It was just too frustrating. And it wasn't working and it wasn't coming back. And frankly, pot's almost like that right now. And it's the same thing because it's really a commodity. I mean, you're buying pot stocks, you're buying commodity stocks. You know, especially the big growers. See, that's the problem. The guys who are public are generally big growers. They're not, I mean, they have obviously manufacturing components to them, but they don't specialize in manufacturing. So you're really always investing in what's primarily a farming activity. You know, yeah, they process the stuff, but that's irrelevant compared to the growing and selling of the actual marijuana plants. The funny thing is, though, that the manufacturers make an incredible markup on what they do, and they don't have the risk of growing it. They don't have to sit there and worry about the crop prices going up and down, and they don't have to worry about huge oversupplies because, I mean, yeah, the machines are expensive, but you know, for example, in California, we bought about $3 million worth of equipment, and the risk to us is that we're not making money back with the equipment because nobody's buying any, nobody's giving us anything to process. But as long as people are giving us something to process, we're making quite a lot of money on the processing. You know, let's say on the average, we'll put out in the machine, we'll put out, I want to say 3,000–4,000 liters a month. And we'll generally get a markup of about, you know, we'll easily, you know, these liters sell for $6,000. So we'll be marking up $600 a liter and we're selling 3,000 a month. That's $1.8 million. That's our spread. That's like Valero, right? It's going back to the same thing. That's our spread. So if someone uses less, they use less, but we don't really have a huge variable cost here. We bought the machine and it's going to get paid for as long as we can make the lease payment on the machine. It doesn't matter if we enter a slow period because we're not the ones that are risking, you know, doing all the growing and so on and so forth that worry about it. And you know, all we do is somebody calls you up and says, as a manufacturer, someone calls you up and says, we need you to process 1,000 liters of plant into THC oil. We're like, yeah, sure. You know, send it over. You guys send it over, drop it off on our doorstep. We'll process it. You come and pick it up. That's our involvement in it. You know, unfortunately, the marijuana stocks that are out there, you can't do that. You're investing in farming. You're investing in gigantic marijuana farms and the manufacturing and the distribution at the retail stores. But the retail stores have their have a footprint. They've got their inventory. You know, obviously we have a warehouse and stuff, but you know, it's a much tighter margin at the retail end than it is at the manufacturing. So why bother doing it? And then you go back to on the growing side, it's like, well, you know, why get involved? Because it goes up and down in price pretty violently on it. And sometimes you may just have too much. And right now that's a problem in Canada. Most pot stocks are Canadian. The problem with them is that there's quite the glut in Canada because they can't sell to the United States. Nothing can cross state lines. All these companies raised billions of dollars when Canada went legal on marijuana on the assumption that how could the U.S. be far behind? I mean, we're not that far behind, but the crazy way we do things in this country is 11 states, 12 states so far are legal, and 5 states are pending, and it's going to have to get to be like 30 states before the federal government is probably going to legalize it completely. So anyway, I was saying though, basically the problem with any commodity is like that though. It's whether or not there's a demand. The soybeans are all over the place because of China. Copper's all over the place because of China. Natural gas is not really predicated on that, but to some extent it is because a lot of natural gas is used in chemical processing, and chemical processing is unfortunately you know, and the end products are used by China. We ship a lot of chemicals to China, and right now it's all wacky what we're doing there. But today, let's look at this. If you want to talk about natural gas, Wednesday, I think I put it up today, either today or yesterday. Let's go to Tuesday just in case, while we're waiting for it to resolve. See, now I'm starting to lean towards maybe it's not the computer, maybe it's the internet that's being slow, right? Because it's taking all this time to load up. I don't think that's a computer function. Hard to say. But it's still going. All right, Control F. At Terrell. UPS, there it is. UPS orders 6,000 natural gas trucks. All right, now obviously not going to put a huge dent in the natural gas supply, but that's very important. That's 6,000 trucks UPS is saying, we're going to use natural gas. And don't think they haven't thought about it, right? They want to be green. They don't see electric trucks are not ready, which obviously is I would say that as a knock against Tesla for one thing, because as much as Tesla talks about all this crap, they don't actually have anything that they can sell you. that the company would want to buy. Notice it begins in 2020, so starting a year from now, starting next year, I mean, starting months from now, until for over 2 years, they're going to put 6,000 natural gas trucks on the road. And apparently they've got a fuel company, and so now other trucking firms are going to take it much more seriously, because UPS wouldn't do it if they're going to lose money on it. The post office already uses a lot of natural gas trucks for their routes. UPS starts doing it, FedEx might start doing it, then bigger trucking companies will start doing it, especially when the infrastructure is being put in place. Because somebody's always got to be the trendsetter. The infrastructure is being put in place to make natural gas a reality, to make it a reality as a fuel source. And that is huge. And that's a long-term trend you want to get in on, but keep in mind, it's long-term. They're talking about 6,000 natural gas trucks out of 200 million cars, and who knows how many trucks are on the road. So it's something, but it's just a long-term trend of use and application. So we'll see what happens. What else is going on? Don't remind me about the Fed. We got the Fed in 20 minutes. CNBC right now has billionaires paid a lower tax rate than working class in 2018. We know that because we were looking at it like a week ago. The point is that it's the same guy. It's not like some special guest. It's that guy who always talks about wealth. So it seems to me like it's really been very slow news week or news month, really, in October, other than this Trump thing, because they're recycling only stories. It's like, this was a story last week. Why are they talking about it now? Is there really nothing going on? It's very odd. And it's also, you're seeing that in the market too. You see a kind of a lethargic sort of move where, we've been going, ever since August, really, it's down, up, down, up, down, up, but we're kind of just fading around in this sort of spot here. Oh, that's interesting. I thought this was your safe charts. It says my safe chart default list. I'm confused. Because that's another one with the line, so I'm wondering what happened to it. Your chart list. Is that what it is? My chart list? Yes, default list, right. I know where it is. The most recent S&P is 8719. That must be it. That's better. So that includes today's moves. I paid big money for a subscription of this thing. And we're right at, effectively, just at the strong bounce line here. So we came down, we tested, look at that, we tested them. Don't forget, this is a chart from August 7th. So back here, we drew these lines. So this is what's going to happen. And since then, this is what's been happening. But look at that. I mean, when you nail a line like that, you know that this is a rule you should be following, right? Look at this up here too. Bottom of this candle, top of this candle, went way over, hit the 50-day moving average, and right back to this line. Very interesting. Now, this 50 days coming down, this 200 days moving up. Eventually, you're going to get a death cross, but it's a death cross in an uptrending 200-day moving average, so that'll be interesting. And down here, you've got this trending down, and see what happens here? When they both start coming under, it's not going to be very easy to move anything up, no matter what the Fed does and what Trump does and what they say about China and this and that. And so we can be down here and doing this for a month before we actually resolve. And frankly, that's what we thought, though, right? We figured we were planning that we were going to sit out for earnings, see what we got for bargains, maybe pick up a few like short puts and quick things like that. And then around the 30th, we start getting serious about getting back into the market. Um, I'm not sure how that's going to play out at this point, frankly. It's going to be tricky with the impeachment and the China and all that. But, you know, look, we got out here September 20th, which is basically here. We were still at 3,000. Now we're at 29.20. I don't have any regrets about cashing out up here. And even when, and the problem is, this is a problem, I'm telling you right now, because you guys are all going to be screaming about this. We go back to 3,000, people are going to be very nervous and we're missing something. But that's a false rally. We've been at 3,000 plenty of times. If we were still running the portfolio, all we would do is lose more money on the hedges and make some money back on the longs. We really wouldn't be making a lot of progress, even if it does that. And you know, right now what we've done is we've cashed out. We've avoided taking a loss, and it's not very beneficial if it starts going up again, though. But if it does go further down, we get a nice pullback. This will be a fantastic time for us to get in. But it's hard because there's a lot of waiting. So if this happens, which is what we're hoping is going to happen, we're going to come back down to like 27.50. I'd love to see that. That'd be a great place to buy. But if that happens, look how long it takes though. It's like, first of all, you got to consolidate, so that might take a month. And then even if we start dropping, you're going to drop, you're going to drop, and you're going to drop, and you're going to drop. And see how perfectly this was all tested out, huh? Right? Perfect candle right between the lines, then down to the line, bounce off the line. Not a great bounce. Then coming back down below the line, almost exactly to the next set, back up. Testing the weak bounce but failing, which is a bad sign. Then you go all the way back down to the strong retrace from that line, from the midpoint, and then you start climbing back up. And you finally got it out of your system. That's what you got to do. And that's what a healthy market does, by the way. A healthy market clears out. People get out. People capitulate and move and leave, and then fresh buyers come in who are willing to buy and hold for longer periods. We don't have that. In the grand scheme of things, we're not really getting that right now. We certainly didn't get it from this entire run to 3,000. We had this little thing, and now we boosted back. Now we're here, and now we're boosting back. There's no proper consolidation. We really need another test of this line to show that that's it, that this is a real base and that we should be going much higher than that. But this is good old 28.50 on this line. And it's still very, you can see right here, look, boom, 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 boom. Very, very significant. Even here, it broke out like from here. Even here, holding, bouncing. Obviously, it's a hugely significant line for the S&P 500. And what's going to be the most interesting is if this dips, this will cross up, this will dip. If we're staying above 2,900, they'll probably meet around 2,900. If we fail here and go lower, this will curve down faster and we'll meet closer to probably 28.75. But either way, somewhere in this range is going to be the death cross. So he'll go down and he'll go up, and that's bad. But a death cross in an uptrending market isn't that bad. And if you imagine it, let's say we're consolidating here and we cross around here, right? And we move up from there. If we move up from there, that's going to be a very strong breakout thing. Because look at this uptrend. You've got this uptrend going all the way from here, and it will continue. And we can then make higher highs. But still, this is a long time away. And the problem is, it's a patience thing. You know, I mean, I think the best thing to do, honestly, in things like this is why cash is useful, because you can just walk away. You know, take days off, do something else, because staring at this thing, waiting for that opportunity to come, because you got to ignore, look what happened yesterday. We had a huge drop yesterday. We had a huge drop, whatever day that was, Thursday or something like that, or Wednesday last week. We had this drop. You know, we didn't do, well, obviously we didn't do anything, we were cashed out, but we didn't do anything here, we didn't do anything here, we didn't do anything here, we don't do anything here. So that's frustrating, I know that is. I'm sitting here, I'm watching it. It's very, very tempting to grab things when we do this. But we don't have a resolution. It could still go on a China trade deal, on a good one, And if it's impeachments, then now the impeachment stuff would have to go away too. We could still get up to like 3,300 on a really good run. On the other hand, though, it's very easy that we could go down to 2,700. So 10% either way. And there's no real way to tell which way it's going to be. What time is it? 1:45. Okay, no questions, so I will just move on with normal nonsense. Oh, let's see what the portfolios look like now. Yep, it's updated. So we do have two portfolios left. We have the butterfly portfolio, which is at 143, which is pretty healthy from last time. That's because we got rid of OIH, thank goodness. Oh my God, am I glad we got rid of that. Speaking of oil, what a disaster, OIH. Look at that. We got out over here and, oh geez, and they collapsed since then. So I'm very glad we got out of that. That's the only position we dumped in the butterfly portfolio. And the rest is just sort of chugging along. I mean, it's 143%. This is our super conservative portfolio. And, well, the margin requirement can't be right. It has to have some margin. But basically, I wonder why that is. Anyway, all right, so we have tons of cash because we just got rid of, we cut back our Apple position. We have these long Apple, I think there were 160 calls for 2020, for June of 2021, I believe they were. We sold those, and that was a big chunk of cash we dropped to the bottom line. And we protected everything else. So we're really, nothing is too risky right now, except for the stupid MJ position is overall risky. Did we sell any short? No, we haven't sold short-term calls. It does nothing but go down. It never gives us a chance to sell short-term calls. We've got Apple, Disney, Mondelez, the marijuana ETF, and Whirlpool. And that's how. Now, we basically had just 4, 5, 6 positions all year long. I mean, ever since inception, and we're up 140%. Just doing the be the house. This is exactly the be the house thing. We take a protected position in the long term. We sell. Sometimes we'll sell puts long term against it because if we feel strongly it's a value play. So we're not being neutral about the position. A lot of these are, in fact, I think all of the surviving ones, I wouldn't call this surviving though, we're just sort of stubbornly hanging on to it. But all the surviving positions are bullish, or what we call artificial buy rates. We take a bull call spread in 2021 and 2022, take a bull call spread, and then against that, we also sell a put because our bias is that it's generally a good play, and then we sell puts and calls. We're neutral about the movement over the short term, and we sell puts and calls in the front months. That is our primary way that we're succeeding in the butterfly portfolio. I'm very, very happy with the outcome at the moment. We're basically a year ahead. So after 2 years, we're a year ahead on our performance goals. So there's no reason that, and again, the reason there was no reason to pull the plug on this portfolio is because it's always fresh. It's always a position, and we sell the front month calls. And next quarter, we'll have a position, and we're going to sell the front month calls. So you can start on this thing anytime. It's not you didn't miss anything, or you obviously missed something, but all you missed is the quarterly profits we keep dumping in. There's nothing inherently better or worse about these positions if you started them today, because the main goal of each position is, and look, here's the gist of it. We sold the March 210 calls for, that's a lot of money, for 46 We don't use this. This was a roll to a two times roll, but it's a lot. So what we have here is we have the January 200 260 bull call spread. That's $240,000 worth of spreads. We only paid $100,000 for it. So we have a $100,000 upside cushion here. We sold 46,000 worth of the 210 calls, and we sold 31,000 of the 175 puts. So the net outlay, and this is ignoring that we made profits on other stuff. Although frankly, most of this stuff we actually already, we just rolled to. But 184, 123 minus 86, 123. Oops, not too many. Minus 46,600 minus 31,500. $19,000. So $20,000. We have a $240,000 spread. And all we have to do, this is why you make so much money in this portfolio. All we have to do is hopefully keep rolling these along, and eventually the Apple has a down month or down quarter, and they expire worthless. And then whatever this is becomes our bonus money. And the same thing, if it went down lower, we then have to roll the 75 puts around there. June of 2021, we have 2 more halves that we can roll to. We can roll to January of 2022, and then we can roll to, oh, I'm sorry, no, I'm wrong about that. I'm sorry, it only has 6 more months we can roll to, because we can roll to the 2022s. But of course, obviously, then we go out to the 2023s for the rest of the play. But anyway, so the point being, the short point being, here's our base position that we spent $20,000 on. In this quarter, we only just sold these in September, so in this 6-month period, let's put it that way, in the 6-month period, we took in $46,000. If this does expire worthless in the next 6-month period into September, we'll sell another. We won't sell this, we'll sell $20-something thousand. Because again, this was a roll because we got buried last time. Although again, we got buried, but we had $150,000 worth of longs that we cashed out on Apple. But these are still hanging around as a negative against that. But still, we sold 46 here. If they ever expire worthless, if Apple's below 210 in March, then it'll be gone. We'll still have our money. Then we can sell another $20,000 against September, and another 20 against the next March, and another 20 against the next September. $60,000 more dollars against our $20,000 position, plus whatever value remains on the position at the end of the time, at the end of the period. And again, this is not our original position. This is only what we rolled to in the last review. So these are very, very powerful plays. And I know they're boring. I wish they weren't, but they are. And they're supposed to be boring because you're just supposed to keep making money. The same way owning a casino is boring. You don't get to bet. You don't get to pick red or black or anything else. The players come in, they bet on numbers, and you bet on statistics holding up. That's all it is. We're not, we're not gambling here. This is gambling the same way poker is gambling. Poker is gambling. There's an element of luck involved in poker. You don't know what the cards are going to be. You don't know what cards are in the other guy's hand. But you do know, if you're a good player, you know the chances, you know the odds. And then if you know the odds, you know what a sensible bet is, and you know what a reasonable expectation is of an outcome. And if you keep making reasonable bets on high probability outcomes, you will do well over time. And that's what this portfolio does. It does well over time. And sometimes you win in a casino, and sometimes in the butterfly portfolio you win, sometimes you lose. It doesn't really matter because you're just playing the game to collect the premiums. The only sure thing in the entire stock market is that the premiums you sell will eventually decay to zero, or buy, whatever you do with them. Premiums decay to zero over time. So you can either be the idiot buying options and be killed by that fact, or you can be the smart guy and sell options and benefit from it. And that's where we are. So Disney, we sold the January 130 calls. They're at 130. And then again, this was a roll, obviously, with a big amount, because usually we don't do a full cover. The only time we have a full cover is if we're in trouble. Not in trouble, but if it didn't go down on us, we had to add more. So we usually start out light and we'll work our way up to a higher number if we have to. So the short January 130 calls, we have $47,000 there too. And think about this as collections on a quarterly basis. Here's 46,000 we might collect. Here's 47,000 we might collect. The 110 puts, if it stays above 110, although that's way out in January 2022. So really the bet here is just on these 130 calls, ending up short. Now, I can't say I'm happy about the January short calls because you got Star Wars and everything else, but we'll see. If any of the movies flop, we'll be in good shape, but I can't see how it would. Why would Star Wars flop? Maleficent might not do as well as they think. And I don't know what else is coming out. I'm sure there's some kind of superhero movie coming out too. Mondelez has been perfect for us, basically. In fact, now we actually sold the 5250 puts and calls. We're looking at, like, we don't know which way it's going to go, so we sold both. Marijuana ETF, we didn't sell any calls, did we? No. We have this bull call spread and we have the short puts. Whirlpool, we sold these January 2020 150s, and we're right at 155. We sold them for 11.90. They're now they're 13.30, so we're showing a loss, but the reality is, how much do we owe this guy? If it's 150, we owe him 475. So again, this number, this 13.33, $9 of that money is premium. And between now and January, if we stay at this level, we're going to pick up $9 times 5 is $4,500. So instead of showing a loss of $713, it would be a profit of $4,500, and that would turn into 5,000, whatever the hell, 5,200. So that could be fun. All right, time for the Fed. Tweet about the NBA. Yeah, the NBA's having fun with China, aren't they? All right, let's look at the Fed. OMC. Meeting minutes, whatever. Oh, not Twitter. Ugh. Not ready yet. Still cooking. So this is the September 18th. So pre-impeachment minutes. So let's see. Well, first of all, let's find out what these news is telling us. They say. Oh.
They will appropriate. It says that it could become necessary for the to need a better alignment of market expectations.
Okay, so several people said that the media was factoring in more rate cuts than they thought was realistic, and they wanted Powell to convey that. But the Fed saw downside risk to the economy. And that seems to be a consensus that there is downside risk to increased downside risk to the economy. And people argued for a bigger rate cut also on the other side. Okay, so here's the minutes. Oof. All right. All right, review tools is very, very boring. Blah, 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 blah. Okay. Developments of financial markets. I don't think, from what I just heard on the TV, there's really not much going on here. Okay. U.S.-China trade tensions, global growth in the following July meeting, the U.S. yields declined sharply. Oh, yes, this is before they had to do the thing with the banks also. These prices moves reversed to some degree in September. All right, trade and economic data turned more positive. Actually, it's turned more negative since that. On net treasury yields remain lower. Oh, now that note auction too. Oh, no. Well, I couldn't have gone too bad because the market's still up. Even after a rebound in September, policy rate expectations, investors viewed it likely the committee would ease further. All respondents from the desk survey of primary dealers viewed 25 increases their target, most likely outcomes. September most expected another 25-point cut by the year end. Further out, no rate cuts next year. That's interesting. Individual forecasts much feel more dispersed, with half the respondents expecting at least one cut and a quarter. Market predictions have been intended to range of global factors: China, United States, Europe, Hong Kong, Brexit, well, if you say Europe, Europe and Brexit. And well, there is a separate problem in Europe, and I guess the Fed's saying that there's a separate problem that, you know, Italy, Portugal, Spain, they're all in trouble. I mean, they all have their economies are teetering on recession right now. So and this is the problem though. The ECB has to act for economies that are doing well. Not that any of Europe is doing that well right now, but you know, the bigger economies aren't doing that badly, but the other ones are in desperate straits. But it's hard to do an easing or something like that in the ECB because you're overstimulating one side and understimulating another. And, you know, I mean, I guess to some extent the United States can be like that with our regions and our cities. But we operate just as a homogenous country, and obviously Europe does not. I mean, Europe still has all this things they have to resolve, which is really kind of the problem. That's why the whole thing doesn't really work. That's why if you look at the euro, where is it, currencies? That's why the euro looks like this. I mean, they got some big problems. And if we go zoom out further, since the crisis, it's been like this. The bottom line is, they look, in the crisis, don't forget, Iceland pretty much, well, Iceland almost went bankrupt. Greece had the problems and all that crap here. This is Greece over here. You know, all the cracks in the system began to show up, and ever since then, it's just been on the sort of downward trajectory, reeling from crisis to crisis to crisis. And all this is a technical bounce. You know, after pulling back from 160, and if you, let's say 80 was the bottom, right? So you go from 80 to 160, then that's 80 points, and that means your retraces are going to be 16 points. All right, so 20% of that, so that would be 144, which is down here. That's a weak pullback. And then 130 is a strong pullback, and it's still going to go the same 16s after that. So then you're going to go to 114, which is over here. All right, and the next support below that is going to be another 16 points below 114, which is basically parity at 1, you know, basically 98. So we can get all the way back down here, back to this $1 line, very easily. Well, I don't think easily. I don't see how it's going to go any other way. And that's going to make the dollar stronger by comparison. That's going to piss Trump off, and he's going to demand more easing. And that puts the EU in a worse spot. It's crazy. So we have all that ahead of us. And again, it's just reasons and reasons and reasons that I wanted to go to cash, because there's just so much stuff like that happening on various levels. It's very hard to like get really enthusiastic about getting long on things. We will find long things. What we'll find is stuff that, like I was talking about with Valera, it's got to be a clear value. And even if the market does drop, because we're gonna be at least half in cash no matter what in our portfolios, more than half. And at that point, for the first 6 months of building new portfolios, we'll be wishing, even though we have positions, we'll be wishing for a big pullback that we could get very cheap positions. And if it never comes, then we'll just build it back up. But I'm very confident in that. Highly elevated repo rates passed through. Highly elevated repo rates passed through to rates in unsecured markets, I think. So they were dealing with that a little bit. It just wasn't such a headline at the time. It was like the last week of, no, it was the last 2 weeks. I guess it was already starting to become a problem. Ooh. Oh yeah, see the repo of 75 billion. So that had already happened. Well, that makes sense. Then see, I guess that that's really, you can see why they would have done a cut, even notwithstanding any trying to make Trump happy. I mean, they were really worried about some things going on there. Economic situation, labor market is strong. GDP was increasing, and now that's certainly not happening in the third quarter. Consumer price inflation, as measured by the 12-month thing, was below 2%. That's based on their bad measurements. Non-farm payroll was solid, although at a slower rate than the beginning of the year. Separately, the BLS preliminary estimate of upcoming benchmarks of payroll will be incorporated in the published data, indicated that the revised pace of average monthly job gains would be notably slow. Well, we know that already. The unemployment rate didn't bother anybody on Friday, right? Only 134,000 jobs. Everybody acted like that was something good. Total labor compensation increased 4.4%, faster than the year earlier. Average hourly earnings rose 3.2% in August. That's good. Wages are technically ahead of inflation. That's what you want to see. Consumer prices increased 1.4%. Blah blah blah. Inflation. All right, nothing. There's nothing exciting here. I mean, it's a big report, so you really got to read through the whole thing. But there is nothing groundbreaking here, and that means the market's not going to do anything. And so the focus goes. The focus goes back to China. We didn't get a big spike in either direction from this thing. It's just sort of drifting along. But don't forget, we smacked up to this level in the futures, and now we're back up here. It's very artificial seeming. And the Russell isn't doing it. Notice that the Russell isn't holding that kind of level. So, there's still a bit of manipulation here. I mean, and Trump, as you know, considers the market to be his report card, and they'll do whatever it takes to try to keep these numbers up. So, we'll just see where it ends up. Oil's testing 52.50 now. That's weak. Copper, where's copper? Copper. HG. Copper's not doing anything very exciting at the moment either. Coffee's still way down, 95.35. I like it down there, of course. Gold is 15.10. Silver 17.82, failing to get over 18 again. All right, good. So what else do we have up here? We have that portfolio. We looked at the butterfly. In the short-term portfolio, we only have the one trade left. What is this? Why you don't work? Okay. So on the short-term portfolio, oh, I can't scroll it because of that. We only have the booking.com thing, and that's going very well also. In this case, it was a bearish artificial buy right, or I guess it's still called a buy right in that case. And what we did here is we took the bear put spread. We bought the 2100 puts. We sold the 1900 puts, so we're hoping it's going to go down below 1900. It's already close to it. We also sold the shorter term calls, 2020s of the 2000s, and we sold the shorter term puts, 1800, and at the moment we're right between the two. And that means we're minting money. So we're up $16,700 because this was a new portfolio. When we put this trade into the new short-term portfolio and went back to $100,000 start. So this trade is up $16,000 already, which many people consider a good year. 16.7% is considered a good year's worth of returns for most people. That in fact is basically Berkshire Hathaway's average return is 16%. So I'm very pleased with 16%, especially when we accomplish it in a month. And the trade, obviously, it's see the net is 60 minus 40 minus 16 minus, it's a credit, so it's a net credit on the spread, but it's potentially a $40,000 spread. So it's a $40,000 spread. We bought it for a pretty large net credit, about a $20,000 net credit, which means that the net could be $60,000 if it all goes correctly, plus the short puts and calls. We sold $40,000 worth of puts and calls for the first quarter against it. And we are going to be able to sell April, and we'll be able to sell July, and we'll be able to sell, October, November, whatever. We should get at least 3 good sales out of this after these. So if we can sell another, that's $50,000. We sold 30,000 here and 10,000 there. It's $40,000. That's $40,000, and we get to do that 3 more times for $120,000. That's pretty amazing. So forget the $40,000 spread. We can make more money selling puts and calls if this thing goes well. So that's fun. I love this stuff. Let's see, and then we have the Hanb Portfolio. See if that's probably still in the loss. 7.4%, and that's because it's getting killed by the MJ. This MJ is down $10,000. That's more than it was only a $50,000 portfolio, so it's down 20% on this one position, and down 7.4% overall. So unfortunately, this one very, very bad position is killing this portfolio. And hopefully that'll turn around too. All right, and we didn't kill the Hanb portfolio because we only started it in May. So it wasn't really like it was worth taking it out. We thought all these positions again. I still like this MJ position. It's just unfortunate we're gonna have to wait for it to all come back. Let's just cycle back after all this overproduction that they've done so far. And they're gonna have to straighten out their things, and they're gonna have to find other markets to count on besides the United States. Lots of changes have to be made for these companies to succeed. But long term, you're still talking about a crop that's way, way, way more profitable than tobacco. Way more profitable. So you don't have to get as many smokers smoking as you do cigarettes. You have a much smaller smoking population because people are paying $7 a pack for cigarettes, right? Or $10 a pack for cigarettes. They're paying for for the same amount of pot, like 20 pot joints, they'll pay $100, $200. So you don't need a very, and again, it's what kind of businesses do we like? We like businesses that cater to rich people. We like businesses that cater to the top 10% because they're not price sensitive. They're happy to buy things, and there's lots of them. There's 30 million people in this country who don't bat an eye at spending $100. That's the top 10%. Don't think twice about it. So, you know, a lot of people be like, oh, pot's very expensive, blah, blah, blah. It's not expensive to 30 million people at all. Then you got another 30 million below them in the top 20%. Also, really not too much of a problem to come up with pot money, right? In fact, in LA, they just opened a cafe. The Howard Stern show yesterday, they were broadcasting from in West Hollywood, which is, you know, Sunset Strip and everything. They have a pot cafe. I bet we can find a picture of it. Pot cafe, West Hollywood. They were broadcasting from the whole staff got stoned. And see, it's nice. Wait, why does that say permanently closed? That was weird. I don't think it's the same place. There's a different place called the Pot Cafe that didn't make it. Oh, so slow. Don't want to see the product, I want to see the outside. Oh, there you go. That's what I thought it looked like. Oh, I think I know her. That's funny. All right, anyway, so I'm actually going to I'll be in California next week, so I'll give you guys a first-hand report and let you know what's going on. But look at this. This is actually what's going on in California. There's an entire cafe where they're outside and they're all smoking pot, and this guy's got a bong. I guess they supply you with stuff. They give you water. They don't serve liquor. They got coffee apparently, and people are just all hanging out in the courtyard and smoking and listening to music and having a good old time. Eat, drink, smoke here. Well, that's a good sign. Oh, look at this. Oh, I'm not going there if there's a line. Are you kidding me? What are they joking? How did it? Wow, that is crazy, huh? This is just like Amsterdam, really amazing. And that's the thing also, I mean, you know, it's obviously we have investments in these cannabis businesses. Oh, look at this French fries, that looks good. So, you know, we invest in this stuff, but the reason we invest in this stuff is because I've been going to Amsterdam my whole life. And I know these are sustainable businesses. I know it catches on with a certain percentage of the population. I know that it's a very popular tourist thing to do. This is not it's not a fad. This is, you know, I mean, look, people have been smoking illegally in this country $50 billion worth of pot every year. So what do you think the legal market's going to be? It's going to be more than $50 billion, but there's a transitioning period because right now most states are still illegal. Even in the states where it is legal, you still have the underground market because they're skirting the taxes and things like that. So it takes a while for you to realize the commercial potential of marijuana, but you know what? That's what happened with liquor too. After a while, it's just not worth it for people to buy illegal marijuana. They tend to go, and it strengthens the legal marijuana business, and people move it up from there. But look at this. This is really incredible. Like the food? That's cool. Oh, wow. Okay, she's totally stoned. You think they have permission from all these people? What's this? Lowell smoke. Oh, look at that. Wow. Oh, that's right, because you can just buy pot. We're doing that with Hanb Portfolio with our CBD company. We're going to be selling out of vending machines, but this is that was a pot vending machine. That's very interesting. Anyway, so what were we talking about? I forgot. Oh, the MJ ETF, right? So, okay, how did we get on that topic? So the marijuana ETF, it's a cycle where it unfortunately the ETF got a little bloated, and we came in a little bit late in to catch the upturn, and now we just have to wait for it to catch on as a more realistic business. But things like that popping up all over the country over time is going to make it a long-term winning investment, even for these great big companies. But it's going to take years. It's not going to be a short-term thing, unfortunately. So that's why I wasn't upset about dumping it out of the other portfolios. We threw everything out, of course, but I wasn't upset about that. And what we're going to do is we only have these three portfolios now. We have the Hanb Portfolio and the Butterfly in the short term. We just looked at those. So that was our entire portfolio review for today. And what we're going to do is we're going to start building up a new long-term portfolio with $500,000 to start. The short-term portfolio's job is to protect the long-term portfolio, but right now there's nothing to protect. So we just have the occasional trade in there. And we'll see in earnings, maybe we'll make some earnings bets while we're waiting with the short-term portfolio. So I'm going to build a watch list. Over the next month, we're going to build a watch list and have stocks that we're going to keep an eye on for earnings and such. During earnings, we'll do some earnings plays in the short-term portfolio, something to do with our cash. We have 100,000 cash in the short-term portfolio, $50,000 in the Hanb portfolio, and $100,000. It was a starting basis of the Butterfly portfolio. And keep in mind, though, okay, here we go. So keep in mind the Butterfly portfolio, we've only got 44,000 in position, so you don't have to have 200,000 in cash. You can still run this portfolio with $100,000. We haven't built it up that much yet. And again, there's no need to. You know, when you can make this kind of money just running half of your just running a quarter of your portfolio and keeping the rest in cash, why kill yourself? You know, again, it just depends on, it's like how much money do you really need? If you can do this on a consistent basis, you'll be plenty rich enough. You don't have to make these great big bold moves to make money. You can just slowly and consistently just keep picking up the change as it accrues to your portfolio. That's what I want you guys to really focus on. And that's what we're very much going to focus on, building these portfolios, which unfortunately is going to make them all kind of boring. You know, so all the fun's going to be sort of in the short-term portfolio. 1020 said that was a bit surreal in California. I think so. It's just, oh, it's crazy. It's like, why wasn't that happening when I was in college? I would have really enjoyed that. So that's, and they are, they're all young kids. Not a place for old folks. So we'll see what happens. Anyway, so that's what we're going to be doing. And next week, as I said, I'll be in California, going over with New Age, and we've got all this major stuff going on there, and lots of meetings and lots of going to see stuff. And we're opening up a new site, another manufacturing facility, so it's going to be crazy. I won't be doing a webinar for sure, because it's, you know, I have to get up at 3 in the morning just to do my regular stuff. But I will be reporting in Monday. I don't know. I'll probably work when I can. That'll be my week next week. I'll work when I can. It won't be all the time. So that's the bottom line. But it certainly won't be no webinar. I just couldn't possibly handle it because I got so much other stuff going on. And that's it. So we're going to wrap this one up. There wasn't too much to talk about. The markets are still in very good shape. And we'll just have to see what holds up into the, I mean, we're past the Fed minutes now. So the only thing now we got to see is if we actually get a China trade deal this week. And I don't know when it actually starts. I thought it was going to start Tuesday, yesterday. It didn't seem to actually start. So now we're just waiting to find out when they are really going to sit down and talk. I'm a little concerned that because I haven't heard anything, look, China, here's where I am with this. China trade meeting. This said hopes are dim Okay, China's resumed trade talks. As dates are set. All right, let's see what that says. Because it was my impression, oh, that's from March. Useless. 2 days ago. See what it said 2 days ago. It was my impression that this thing was starting on Tuesday. Monday ahead, fresh level, scheduled to begin later this week. Well, what's that say? Chinese officials have said, oh, here you go. When they meet with the counterpoints in Washington, Thursday and Friday. He would arrive. So Xi's #2 guy is coming to Washington with terms for a deal that won't include commitments on reform. We know that, government subsidies. So the U.S. has said that's a deal breaker. So we'll see what actually happens. I was under the impression that Tuesday and maybe Wednesday, the little guys were going to come and pave the road to have a smooth meeting. I don't think that happened. Otherwise, there'd be some sort of word coming out about something happening in the trade thing. I think the little guys didn't come. I think that Trump disrupted it with what he did. I think that makes it impossible for them to come to an agreement on Thursday. How do you come to an agreement if you didn't prepare for it? That just seems very unlikely. We'll see what happens. But as I said this morning, though, I think they're desperate. Trump is desperate to make an agreement. He has to have some kind of deal to show that he did something worthwhile. And I think he'll take almost anything the Chinese offer him at this point. So we'll see how the Chinese feel about that. They have to decide whether they feel, all right, so then you got to put yourself on China's side and say, well, all right, I got Trump over a barrel. He's willing to agree to almost anything. Do we benefit by making this deal now, or do we benefit by waiting until he's in more trouble? And that depends on what the Chinese are really looking for concessions or how hard the U.S. fights here. But I think if basically they're going to go back to the same crap, just like the Mexico thing, nothing happened. Trump signed the NAFTA 2 deal. It's the exact same deal we had with NAFTA. And he acted like there was a different deal. There was no different deal. It was the same exact deal. Almost no variation at all. So China, assuming they want to just go back to whatever we were doing before, could just say, well, there you go. That's what we got. China may want to wrangle some other concessions out of us. They can't imagine what, though, because they do have a pretty good advantage over us in trade. I guess they may want to obviously remove all these bans and stuff. But on the other hand, there's also the train of thought that Trump may be addicted to the money. The tariff money is like a slush fund he gets to play with. He's handing out cash to the farmers right now. He needs that money to buy the election at this point. He knows he's not going to win the election. He can't get everybody on his side. So he's handing money out to farmers and doing whatever he can. This tariff money allows him to spread money around and pretend it's for this or that. It's really obviously to buy back votes when he can. So to some extent, he doesn't want that money to be cut off when he's running for re-election. But on the other hand, he also needs to show that he's doing something positive. But I guess he can always make it look like, China just wasn't ready to cooperate, or China wouldn't make a deal on key points and blah, blah, blah. And he'll say, I'm hanging tough, and you need a tough guy to be your president, blah, blah, blah. We heard all this before. So what does he think is going to be the best chance of him getting reelected? Having a lot of money to spread around and saying the Democrats are weak on China, or even saying that the Democrats blew up the China deal? That's a good narrative. I like that. See, he can have China walk away from this week and then blame the Democrats for causing the problem, saying I had a deal all ready to go, but the Democrats blew it with this nonsense that they're doing with the impeachment. Ooh, that's it. Okay, that's a winner. If I was Trump, that's what I would do. I would go through the motions of the trade thing, let China walk out, blame the Democrats for it, increase tariffs on China, and get more money. And then use that to buy off more farmers and more factory people in the Midwest where he needs the votes. So in the end, not good for the market though. So we still have to be very careful, and we're gonna have to be just watch and see what happens into the end of the week. But that just makes me start leaning back towards it might not be a trade deal though, because I see a way where Trump can spin that as a win and keep his money, which he likes that tariff money. All right, so we'll find out if I'm right or wrong next week, although I won't be here, but we'll touch base again when I get back. All right, thanks for coming, everybody. I appreciate it. Oh, well, anybody got a question? John says, any chance for a new options opportunity portfolio for 2020? I doubt it. I think that we might do something different, but I don't think there'll be the options opportunity portfolio is really just sort of a mishmash of the long-term and short-term positions. So, if you take the long-term and short-term portfolio and you divide everything by 5 to bring it back down to about $100,000, that's the options opportunity portfolio. So I always felt like that was incredibly redundant out of the portfolios we were running. So I don't believe I want to do that again. We will be starting a money talk portfolio though next quarter. So when we do our trade of the year, that's going to be the first trade in our money talk portfolio come November-ish, Thanksgiving usually. That is going to be a $100,000 portfolio that we will build up. So instead of the options opportunity portfolio, we'll be doing the money talk portfolio. But don't forget, it's a very low touch portfolio compared to the OOP. The active ones are going to be the Hanb. Oh, and then we're going to be starting another portfolio that'll be based on sort of like something similar to top trade picks. Oh, and I'm having a meeting with the street. Or I might start doing stuff for the street because the Maven bought the street, and I work with the Maven. So we'll see. All right, but there'll be more portfolios, not just these. I doubt it won't be called the options opportunity portfolio, and it will be somehow different. I'm tending towards more of a top trade kind of portfolio. So we track those because those are phenomenally successful. Everybody ignores them because we don't have a portfolio, but those top trades are amazing. So something like that is more likely. All righty, that is it then. Thanks everybody for coming, and we'll see you in 2 weeks. All right, take care.